This is trueflation numbers. Trueflation right now has at 3.49% in regards to the current inflation rate right now. This means essentially what you're going to see next month when the numbers come out, you're going to see a low 4, you might even see a high 3, okay? A low 4 or high 3 is what you're going to see from the government numbers next month. And I would say this entire summer, you're likely going to see CPI either 2 or 3. I feel pretty confident with 3. 2 is maybe a little bit of a stretch. We'll see what happens, but that's what you're going to see this summer, which is, guess what? Going to be right in range for what the Fed's looking for. This does not mean they're going to just cut rates right away, unless there's some sort of systemic problem, and let's say a bigger financial institution went under or something like that, which is a whole other kind of stretch to kind of get there. But now at this point in time, the Fed needs to do nothing, absolutely nothing. Okay, Jerome Powell can go on summer vacation now at this point in time. Okay, now next component that matters in a significant way, we've got to talk about the Treasury market. Think about it this way, right? Tons of people selling those stocks, right? Remember, people were selling me Meta at $90 and $80 and all those prices, right? So people are selling and selling and selling and selling and adding all this massive amounts of selling pressure. How do you get the biggest companies in the world to go down 40, 50, 60, 70, 80% like they were doing in 2022? The only way you get there is just insane selling pressure on those stocks. There's just not even enough buyers on the other side that the prices just keep going lower and lower and lower and lower, okay? So think about it like this. Where was all that money going? Well, some of that money could have been going into what is seen as safety stocks, right? Could have been going into, food companies or Walmart stock or Procter & Gamble and Johnson & Johnson, oil and gas stocks, right? And some of those stocks I don't really view as safety stocks, but Wall Street looks at that. So some of those stocks go there, or some of that money goes there, right? Another ton of that money goes into the Treasury market, because the Treasury market's been yielding very good. So a ton of these Wall Streeters, big money, whatnot, put a ton of money, especially in the back half of 2022 and into the beginning of this year, into 1 month, 2 month, 3 month, 6 month, 12-month treasuries, right? Buying all these treasuries because you could get about 5% roughly on your money. And it's basically seen as guaranteed money, right? Which is a beautiful thing. So now, think about it in terms of two ways. One is when that money returns to the market, it's actually going to be more money. If you put $100 million in treasuries, let's say, for example, it's a really big number. Just really want to use a big number to illustrate this, okay? You buy $100 million worth of treasuries and you make 5% on that, you now have $105 million. It's even more money to return to the market, right? But what happens when these treasury bills mature? Fair question. Well, then these individuals that have all these treasury bills are going to say, either I want to roll this into treasury bills again, or I want to go ahead and funnel this money into the stock market, which puts a whole level of buying pressure out there, right? And it really depends on how folks are feeling at that time. If they feel more comfortable with the market and they want to position more into, what they're going to do is, as their treasuries mature over this next 1 to 12 months, which there's a massive amount of treasuries maturing over the next 1 to 12 months, is if they feel more comfortable in the market, they're going to return that money to the market. It's going to obviously cause the market to go up quite substantially and a ton of stock prices to go up quite substantially, because you'll have a back inflow into all these stocks. Because it's like, oh gosh, I sold Apple at 125. That was so stupid. I need to buy back at 225. Whatever. Like, that's Wall Streeter logic right there. Okay, Wall Streeter logic. Okay, so this is something that's very important. It's money's going to return to the market at some point in time, and it will be more money than before, right? To add on top of that, savings accounts have been yielding 4 to 5% themselves, not from obviously the big dog banks like JP Morgan and Bank of America and Wells Fargo and those guys, but for all the other ones, you can get consistently pretty much out there 4 to 5%. So when, once again, people feel more comfortable investing back into the market, right, and they get back in, they're going to be bringing substantial amounts of money with them, and probably even more money than what they left with, because they were able to get 4 or 5% on their money while it was on the sidelines, while it was in hideout time period, okay? This is something that matters in a significant way, that is a risk factor to the upside, actually, in the market that's not being considered. It's also a reason that if you do get earnings to go down in the S&P 500 in general for the back half this year, it makes it hard to get the market down in a substantial way, because there's so much flipping flapjack and money tied up right now in treasuries and savings accounts that any dips out there people are going to be ready to buy those. Think about that for a moment, okay? So that matters in a significant way. Home Depot. Oh boy. Not good. All right, so Home Depot here. Net sales down about 4.2%. So obviously, you don't want to see revenue going down like that, 4.2%. The worst part of that is, you can say, well, in the economy, we've had inflation of, let's say, I don't know, we can throw a number out there, 6% over the past year. You can say maybe it's 7%, whatever, okay? So let's say it's 6%. So if everything's gotten about 6% more expensive, then really there's a net difference of about 10% in terms of Home Depot's revenues, right? I mean, imagine if everything stayed flat pricing, right? And prices didn't move up, then you could say there was maybe a scenario where Home Depot's revenues would have been down 10% if you want to look at it from that angle, right? And so nonetheless, folks, I mean, that's troubling, but I actually gave them a blue on this because I'm surprised it's not worse. I mean, with how weak the real estate market is right now, I'm actually amazed that their revenue didn't come in worse. I'll be honest, okay? No, troubling is a gross profit actually fell more than their revenue fell, which is not something you want to see. Usually, if revenue is down 4.2%, you'd like this number to be down maybe 3.9%, 3.8%, 4.1%, something like that, okay? The fact that it's down more than revenue is not ideal. Operating income gets even more troubling. That was down 6.4%, so, quite a bit outstripping revenue as far as that goes. Net earnings down 8.5%. So now we're talking about this is over a double up in terms of how much this number's down versus revenue down here, okay? Not good at all. Basic earnings per share down about 6.8%. So reds across the board. Obviously, there's weakness in Home Depot's business in a substantial way, which doesn't surprise me whatsoever. This is something I thought was going to happen, and this is one of many reasons why going into this year, I hedged with SDOW. Because Home Depot is a very big weight in the Dow Jones Industrial Average, and I thought Home Depot would be very weak this entire year. And I don't think this is going to fix itself. I think Home Depot is going to continue to report, very, very troubling numbers for likely the remainder of this year. But I'm actually, I think it could be a lot worse for Home Depot. I think it could be a lot worse for Home Depot, okay? Now, this goes to show you where weakness is coming. Customer transactions, that's where the whole weakness is coming. Customer transactions were down 4.8% on a year-over-year basis, almost 5%, right? Average ticket actually grew slightly. What this tells me is you got to think about this for a moment. Have you ever moved in your life, okay? Have you ever moved out of an apartment, out of a home, whatever? What do you do when you move? You make 1,000 trips to Home Depot and Lowe's. Anybody that's ever moved in the United States of America, you know what I'm talking about, man. You have to get all this moving crap, okay? Whether it's boxes, whether it's bubble wrap, whether it's tape. And then when you move into your new place, you have to get a bunch of random new stuff, and you end up still going to Home Depot and Lowe's many times, okay? And so nonetheless, when you move, you're going to likely make a lot of trips to Home Depot and Lowe's. Well, obviously the real estate market's weaker, in a much weaker state. So if that's the situation, guess what? There's going to be less transactions at Home Depot. It's a very natural occurrence. And so it doesn't really surprise me. It's just kind of, you put the pieces of the puzzle together there, and it kind of makes sense. So, that's that. But that's not the most troubling thing with Home Depot. This, what I'm about to show you, is shocking. I mean, absolutely shocking what I'm about to show you here, okay? This is Home Depot's balance sheet. This might be the worst balance sheet, or certainly one of the worst balance sheets of a big dog company, a multi-$100 billion market cap, okay? They barely have any stockholder equity on this company right now, okay? Barely have a positive stockholder equity. That's crazy. I mean, look at this. They have total assets of $76 billion, and they have total liabilities of $76 billion. They barely have any stockholder equity. And that's shocking because, I mean, that's just not something you usually see. You can go through the biggest big dog companies out there, and almost all of them are going to have stockholder equity of many billions of dollars, and some of them tens of billions of dollars, some of them $100 billion plus. To see a company like this barely have a positive stockholder equity, that just proves that management over time has loaded this company up with massive amounts of debt over the years, which is exactly what's happened. I mean, look at the long-term debt, excluding current installments, over $40 billion. And the cash in this company is only $1.2 billion. I mean, it's amazing that a company like Home Depot, what is supposed to be seen as one of the most quality companies in the United States of America has a balance sheet this bad. I mean, you can understand that if it's some, random stock that is some crap company. This is Home Depot we're talking about. This is one of the most prized possessions of the stock market. To have a balance sheet this bad is embarrassing for a company like that. And the thing with a balance sheet like this isn't going to fix itself in the short term. It's going to take a while to play out. And I mean, imagine there was some sort of scenario where the economy got really, really ugly for a few years. And imagine, I don't know if this is even realistic, if Home Depot was to actually take losses. But I mean, for a company like this is how these guys end up going bankrupt over time. And for a company like Home Depot, you better be taking Amazon serious. When Amazon gets down 1-2 hour delivery, which they will over the next few years, I'm telling you, it's going to be a whole lot more of a competitive threat to Home Depot. Amazon now has gotten to the point where I order something and it's at my house in less than 24 hours. They will get to a point where it's in my house within 2 hours. And when that happens, I can tell you Home Depot's in a world of hurt. And as crazy as it sounds, could Home Depot be a bankruptcy candidate someday? Folks, there are every retailer that has gone under over the past 10 to 20 years, there was a moment when people thought that company would never go under. They are giant. No way. I mean, this is ugly, man. And there's no fixing this in the short term. And this is a company with almost a $300 billion market cap on it. Almost $300 billion. I don't think people are taking into account on Wall Street the level of risk in Home Depot. And I think it should be something that is taken very serious, okay? And we'll see how this story plays out over the next 5, 10, 15 years. But this is going to be interesting. When you have that bad of a balance sheet and you're in your glory days right now, this is Home Depot's glory days. Let's be clear about that. And when you have this bad of a balance sheet in your glory days, what's going to be when your business is not in its glory days anymore, which could be the start of it? That's bad, man. So that's Home Depot, okay?